To take you through the next instalment of Chapter 3. And Chapter 3, as we know, is finance. And the next instalment is going to look specifically at the tool break even. So this comes under 3.3, and we're going to look at the calculations to do this. We're going to look at the graph, and we're going to identify profit and loss from break even. So the first thing we need to do when calculating break even is we need to understand the contribution that that the sale of each item makes towards paying off my costs, my fixed costs. So contribution refers to the sum of money that remains after all direct and variable costs have been taken away from the sales revenue. This is essentially the amount available to contribute towards paying the fixed costs of production. So in the case here, we have a Everton shirt, which has a sales price of £50. And that Everton shirt had a variable cost per shirt of £20. That means that the cost of the materials and the cost of the packaging and the cost of the logo that's been sewn on and all of the signage on it, all of that per shirt has cost £20 to make. This shirt costs £20 to make. But that doesn't consider the rent in the factory that we've used to make it, or the salaries of the people who produced it, the insurance on the company that produces it. All of those costs have to still be covered. So the contribution says, well, how much do we make per shirt, our sales price? Take away the variable cost, how much it actually costs to make the shirt, $20. And what you're left with in this case is £30. And that £30 is what we call contribution, because it contributes to paying the fixed costs. One shirt can't pay all of the fixed costs. One shirt isn't going to pay for all of the rent and all of the insurance, but all of the shirts together will contribute £30 each towards paying off those fixed costs. Once we've covered the fixed costs, then we can make profit. This is contribution. It's calculated as price minus average variable cost. Once we've got contribution, we can calculate break-even. So break-even analysis is where we identify how many units a company needs to sell in order to cover all of the costs. So that is the fixed costs and the variable costs. So we understand that a loss is made when the costs of production exceed the revenue of the business. And a profit is made when the revenue exceeds the cost of production. Well, break even is when the revenues of the business equal the cost of production. So this is a calculation that shows us a number of units that are to be sold in order to just cover the cost of production before you make profit. So if we think about contribution that we've just talked about, break even is the fixed costs divided by the contribution per unit. And I'm going to go back because remember, the contribution per unit, this number is the price minus the average variable cost. So the price of the selling of the shirt minus the amount it's cost to make that shirt. We've already paid for the variable costs when we get to the contribution because this is what's left over. So this is what's contributing towards paying those fixed costs, the rent, the insurance, etc. Okay, so the calculation is very simply fixed costs, the total fixed costs, divided by the contribution per unit will tell me how many units I need to sell to cover all of my fixed costs. That is break even. Break even is the number of units that I have to sell to cover all fixed costs, calculated as fixed costs divided by contribution. Once you've calculated your break even, you can then go on to graph it. Now, not all questions ask you to graph it, but you have to be aware of how to do so if you need to. Remember, if you are going to produce a great break-even graph, do ask for graph paper in your exam. Okay, so here we're going to produce a break-even chart, and I have two axes, okay? And my two axes are labelled clearly units output and costs and revenues, okay? So the units output is the number of units, and the costs and revenues is a amount in dollars, okay? And you can see I've already got some numbers on here. Where have these numbers come from? Let's find out. My units output goes from 0 to 800. The reason why is because in my information table here, I'm told that the quantity of sales is 800 units. So the units output goes from 0 to 800. So why then does the cost and revenues go from 0 to 2000? Well, what is going to be hopefully higher? If I'm profitable, is the highest number going to be my costs or my revenues? It should be my revenues. So what is the potential revenue if I sell 800? Well, that will be $2.50, the price per unit, multiplied by the quantity, 800. Price times quantity is sales revenue. 800 times $2.50 would give me $2,000. Okay, so you always scale your table by 0 to the maximum number of output and 0 to the maximum sales revenue. Next thing we need to graph is our fixed costs. Fixed costs do not change with output, so we're looking at a straight line. And in this case, it should be at 600, so around about here. There we go. So here's our fixed cost line. Notice it's straight and it's labelled. The next line that we're going to add is our total cost line. Our total cost line has to consider the fixed costs, 600, and the average variable costs. Now, 600 is still the fixed costs even if I sell no units of output. So my total cost line can't start here at 0, it has to start here at 600. Now it's not going to go up to 601, 600 plus 1, because the average variable cost of $1 is per item. So what I want to do here is I want to say average variable costs times quantity. Okay, so the average variable cost of $1 times the quantity of 800 is $800. So what is $800 more than the fixed costs? Well, 600 plus 800 is 1400. So I'm expecting my total cost line to come just underneath here on this line as so. Okay, here's my total cost line. Next, it's my sales revenue line. And this should be really simple if you've got your scale right in the first place. Because if I sell no units, then I make no sales revenue. But if I sell my maximum units of 800, then I should make my maximum sales revenue of 2000. So a diagonal line that goes corner to corner. And you need to check that your scale is correct. So you should always go to your maximum output, 800, and your maximum sales revenue, in this case, 2000. So, okay. So we have fixed costs, we have total costs, and we have sales revenue. As you can see, in this case, the line at which the total costs crosses underneath the sales revenue, okay, where the sales revenue becomes greater than the total costs, this is what we call break even. Okay, and in this case, you can see that the break even unit is 400 units. So this company needs to sell 400 units in order to break even. Now we can calculate that because we could do just simply our price minus our average variable cost, which is £2.50, minus £1, okay, is going to give us our contribution. So what's £2.50 minus £1? It should be £1.50. And you should also know that if you divide 600 by £1.50, fixed cost divided by contribution, that's my break-even point. So this is what a basic break-even graph looks like. I need to make sure that all graphs have a title. So this will be break-even chart for company X, whatever the company name is. There's one more thing that we can put on our break-even chart, and it's called the margin of safety. This tells us how many units can the company afford not to sell, say in a bad month, before they make a loss. So currently our company anticipates the sale of 800 units a month. It only has to sell 400 to break even. So its margin of safety is this distance between break even and maximum output. Okay, so it's calculated as maximum output or quantity minus break even, and that number there is what we call the margin of safety. So in this case, this company has a margin of safety of 400 units. It could afford to not sell 400 units of the anticipated outcome before it makes a loss. With that in mind, from margin of safety, we then have to consider calculations for profit and calculations for loss. Okay, so we know that everything in this side of the graph, this side, is profit, and we know that everything this side is a loss. but how much profit has been made? Okay, we know that the profit's been made because sales revenue has gone above total costs, but how much profit? Well, profit is very simply calculated as sales revenue minus the total costs. In this calculation here, we can look at total revenue. We know that total revenue being price times quantity was $2.50 times 800. That gave us 2,000. That's why our sales revenue line totaled at 2,000. So our total revenue is 2,000. We also know that our total costs line, fixed costs plus variable cost times quantity, which was 600 plus $1 times 800, gave me 1,400. That was why my total cost line was here at 1,400. So I've already done those two calculations. So all I need to say is 2,000 minus 1,400 gives me my profit or loss calculation. Now, regardless whether the company makes a profit or a loss, it's the same calculation. Total revenue minus total costs. If the outcome number is positive, then you've got a profit. If the outcome number is negative, then you have a loss. But this would be the outcome calculation for that question. Now, as far as benefits and limitations of break-even is considered, you have to think about the fact that break-even is really useful for what-if planning, to look for the future, to be able to see with our current pricing strategy, how many units would I have to sell in order to cover all my costs? Or what if I changed my pricing strategy? What if I sold them at X price? What if I sold them at Y price? What if I have a sale and reduce the price but increase the quantity sold? How many would I need to sell in that case in order to break even? So it's useful for what-if scenarios. It's also really useful for businesses that sell single products and make products to order. And the reason being is that the break-even chart relies upon a singular price and a singular average variable cost. So if you have multiple products, it's likely that each of your products will have a different price and a different variable cost. So your break-even chart is going to be an average price and an average variable cost of different products that you make. So it's more accurate for businesses that just sell one product. It's also more accurate for businesses that make products to order, because what we're saying about this output, if we go back to our graph, these units of output, these 800 units of output, we've made 800 units, but have we sold those 800 units? Because we're presuming that our sales revenue is the same as our output. But what if we've made these and they're sat on the shelf waiting to be sold? That would mean that our output is still here, our total cost is still here, but our sales revenue may be much lower. Okay, so in actual fact, this is reliant upon the idea that we've sold every item that we've made, which is why the break-even chart is more accurate for companies that use a just-in-time method of production and make their products to order, because they know that each product that they make will be sold. The limitations is that the model is what we call static. It doesn't change within the environment that it looks at in its business situation, meaning that, for example, costs and revenues are linear. So, to give you an example of this, looking at the chart, my total cost line here, okay, this says that my fixed costs obviously don't change with output, and my total costs continue to rise by units output. But we've learned, using economies of scale, that the more units I buy, the more raw materials I buy, the lower the average cost should become. So theoretically, I should see a little bit of a curve or a little bit of a hook at the end of my total cost point, okay, to suggest that I'm benefiting from these economies of scale. But it doesn't do that. It relies upon them being linear. So it's not 100% accurate in that sense. Just as it's not 100% accurate that fixed costs don't change. It's wrong to say fixed costs don't change, even with output, because, okay, imagine I have a factory and that factory has the capacity to output 1,000 units, okay? So right now my fixed costs don't change. And for the next section of the graph, my fixed costs won't change. But if I have to produce 1,200 units, there's a possibility that I'm going to have to expand my factory. My factory might have to get bigger, or I might have to open a new factory. That is going to increase my rent and or increase my electricity bills and insurances. So actually, at certain stages, at certain thresholds of output, my fixed costs will change. So it isn't true to suggest that these costs are linear. However, the break-even chart believes or assumes that they are linear. So this is a disadvantage of it. It's one of the things that makes it slightly inaccurate. They also doesn't necessarily reflect changes in price or in level of demand. So as companies have introductory pricing and then prices settle or change, or companies have sales and things like that, you would have to change your break-even chart to reflect those changes in price. One model can't show various different price points. Or, as it points out there, the level of demand. So what we were talking about before about having these products made to order. You know, if you have products left on the shelf because there's a lower level of demand, then the break-even chart doesn't take that into consideration. So these are some of the benefits and limitations of break-even, and that is break-even analysis. Okay, so the next instalment will continue in 3.4, which is the profit and loss account.